Good day, everyone. Well, the continued dislocation in the bond market due to too many sellers of bonds and not enough buyers has resulted in rising yields. And that, of course, pushes stocks lower because the bonds are more attractive investments compared to stocks. And the canary in the coal mine could be what we just saw play out recently in the UK. And some have said that sooner or later, the Fed is going to have to pivot and go from being a net seller to a net buyer of treasuries. But in the meantime, every Fed member is deeply hawkish. And for reasons such as the owner's equivalent rent index, which increased 0.8% month over month. That was the largest increase since June 1990. On the other hand, initial jobless claims came in above expectations at 228,000 versus the estimate of 215,000. And inevitably, this jobless claims metrics should continue to increase as unemployment also starts to jump, at least if all other prior recessions are any indication. Now, we know that the CPI came in hot at 6.6% core versus 6.5% year over year, and 0.6% core versus an estimate of 0.4% month over month. The overall was 8.2 versus 8.1% year over year. And shelter inflation came in at 6.6% year over year. And that's the highest on record. And that's up from 6.24% in August. Rent inflation itself was up 7.2%. That's up from 6.7% in August. And that's also the highest on record. So these factors alone contribute to over 40% of the total increase in all items in the CPI ex food and energy. And that's really not much of a surprise because, as we've been saying, the rent data flow through the CPI, into the CPI on a 6 to 9 month delayed basis. So inflation, it keeps defying the economists' forecasts, and people are still clinging onto the belief that inflation will fall. Yet the CPI showed inflation across major sectors such as shelter and medical care. After the CPI report, the CME Fed futures now predict 2 75 basis point rate hikes for the rest of the year, and that brings the FFR to 450 to 475. Historically, the Fed has never hiked rates so aggressively, but then the world had never seen so much debt due to C19, along with a multi-millennia year low in interest rates. So markets tanked on this news, but due to short covering and the hope of inflation coming off its peak, created a massive reversal to the upside. And this happened last Thursday, where the major averages tanked, then soared due to a short squeeze. And this resulted in the fourth largest trading range on the NASDAQ composite in its history. Friday then brought big selling as the market realized the macro backdrop looked as bad as ever. And the CME futures are pricing in near certainty of a 75 basis point hike in November, and also suggesting one in December. So many mutual and hedge funds went short or bought puts because everything looks pretty bad. And inevitably, a short squeeze has been playing out so far this week. Earnings are coming in strong, such as the Netflix one. They had a revenue beat as expectations have been reduced, and so that makes the beating of the lowered estimate targets easier. So from here, maybe we continue to dead bat bounce until we get closer to the next Fed interest rate meeting on November 2nd. That's 2 weeks away. Interestingly, the July-August earnings season was very bullish for the markets, but that was coupled with the hopes that inflation would moderate, and so the Fed would be softer, and so we had a multi-week bounce from mid-June to mid-August. And on the other hand, the April-May earnings season was met up with gap downs in major stocks when a downtrend, which started at the top of April, was firmly in place. And the downtrend was partly due back then to the Fed being increasingly hawkish. So right now, I don't think there's a lot of hope that inflation, well, there is hope inflation will moderate, but in the meantime, the Fed's not soft, and they made it very clear And so I think this downtrend we've been in with these occasional spikes higher, which look like short covering rallies, probably remains intact. I don't think you can go by earnings so much because, like I said, in the last earnings season, there were some strong reports, but the earnings prior, there were weak reports. So what's this going to be? I mean, probably anyone's guess. It's going to be strong or weak. And we are in a downtrend. So, you know, hope remains that the Fed could become less aggressive on rate hikes because stuff is starting to break. But in the meantime, I think we're going to keep hearing evidence that the Fed has to do what it's set out to do. The CME Fed futures is a good watchdog for that. So I think we're at like 96% odds of a rate hike in November, and then I think also very high, like something like 80% rate odds of a rate hike, 75 basis point rate hike in December. And that just seems like the back of the markets would break at that point if we get there. So let's see what happens. And in the meantime, Gil, how are you seeing everything?
Well, I think there's a couple of ways to look at things here. And the first is that you are in this panic zone. So when you look at the indexes, you've undercut the June lows. You had an undercut and rally last Thursday. That was immediately negated on Friday, but then on Monday, it was back on again. So for now, what you have is a de facto undercut and rally in the indexes and in what is now a 4-day rally. I don't view this as a less than, well, a 5-day rally. So you go 1, 2, because this day held above the low, so it's still part of an uptrend. So you're in a 5-day rally off the lows. Now that is the biggest rally we've seen since the peak in mid-August when the market, or the S&P rather, ran into the 50-day moving average. So let me actually bring up the NASDAQ composite here. Yeah, so to me, you're in a 5-day rally still. We're down slightly today on the NASDAQ, but the day's not over, so we'll see where this ends up going. But you can see, you know, the rallies, the longest one you had was 4 days here. Then you have this one in here, 2 days, and then 2 days. So before Monday, you've had 7 rallies since then, and the average duration has been 2 days. So that may remain the case. But on the other hand, the other thing to think about is this, and I think this is critical, is that remember that when the Fed started raising rates, it wasn't until the market had already been raising rates for a long time. So the 10-year yield was already pushing higher. Market-based interest rates were all pushing higher long before the Fed decided they had to raise rates for the first time. And what was that, Chris? In early, like January, February? When did they do it the first time?
Yeah, something like it was early this year, and that, of course, motivated the nice downtrends we've seen. The shift to hawkish was in November, actually, when they removed the word transitory. Then December, they became even more hawkish. Right. So that, of course, November was the market top.
Yeah. So since and the 10-year yield, if we look at the 10-year yield, we'll look at it on a weekly chart as an example, and we can see that it started rising off the bottom at the end of 2020, and then in 2021 it based for a while, and then it has taken off. But it started rising long before the Fed started raising rates, and it's been rising ever since. And notice that the TNX today is at 4.08. I think that's a new high. So interest rates are rising and continuing to rise on a market basis. And the Fed is going to raise another 75. That's what the projections are for November, correct?
Correct.
Yeah, that's what you said, right? So that's what they're looking at. So my guess is the thing you got to watch out for is the market's going to figure out before the Fed when the Fed eases off the interest rate increase gas pedal. So, I think that's what we have to watch for. So I don't think we can poo-poo any rally as not being a potential low, although you do have to see other things line up if you're going to start playing it on the long side. So that's another issue altogether. But I do think that the market will figure out when the Fed is going to stop before the Fed does, because I don't think there's any way they're going to get up to high enough where they get higher than inflation, which theoretically is where they need to get before they can before it can even have an effect. So I think that's really the main issue, because the debt now is over 31 trillion, and how do you service the debt? You know, Janet Yellen last year, I think, said that the debt wasn't a problem because it's the cost of servicing the debt. Well, that was back when interest rates were 0%, and she was too dumb to figure out that interest rates would be rising. So now you got, what are we seeing now? 3.5%. So they do another 75 bips. You're at 4.25. And it seems like the TNX has head that way. The TYX at 30 years at 4.09. We're at 4.06. 0.86 on the TNX. So I think that's really the crux of the matter. And it's just creating a lot of volatility in here, I think, because the market is trying to sort this out. And again, I would rely on the market first before the Fed comes out and says, oh, yeah, we're going to reverse course. The market will figure it out first. So you want to be, have your list of potential ideas coming off the lows, because we do have the tools to buy stocks off of their lows using typical owl long entries like undercut and rallies. And right now we have an undercut and rally enforced for the S&P and the NASDAQ. And let's see, probably the Dow. Yeah, and the Dow is actually making higher highs. So, I mean, it was a narrow undercut and rally from the week of 3 weeks ago, or the low of 3 weeks ago. And now you're back above the June lows. So there you go. So it seems to me that the potential for this rally to continue, and I think at least as far maybe as a 50-day on the S&P and the NASDAQ. So let's see, the S&P now is here. So you've got some room on the upside, and you've got this 3,800 level. If it gets through that, then you're heading for the 50-day line. But it seems to me like they tried to kill the market a couple of times today. So far, they're not doing it. And I've been flipping back and forth trying to get some traction one way or the other. And now I think we'll see if we rally, but I'm starting to get turning signals on some of the stocks I've been watching as they've been coming down. And I'm watching things like some of the miners. So you got a little turn in here, but it's kind of hanging off these 1250 lows. So that's kind of an intraday undercut and rally, which I think is playable, and you use that prior low there around 1252 as your selling guide. Keep it tight, and then we'll see where it goes from here. But other things, I'm watching silver miners. Same thing here with AG, is trying to turn off the lows. You got a little undercut and rally going on. We'll see if that holds up. It doesn't have to, but I'm more inclined to test the long side in here until I see a bona fide failure. That could come in 5 minutes, I guess. But for now, I see things lifting off the lows over the past few minutes as things look like they were going to reverse and turn back to the upside. So meanwhile, you've got names like Netflix reporting earnings. And I think one of the things, if you want to be a swing trader in this market, and I'm going to emphasize that that's all this market is good for, swing trading and day trading, okay, then you've got to be quick on the draw, and you've got to be ready to dance, basically. And sometimes these things are dancing all over the place. But and if you're not oriented that way, then I say just stay out. You don't really need to come in. There's no real major trend developing. Now, the thing that can add some coherence, some concrete sense of concrete setups to the environment is something that occurs after earnings, because now we're into the thick of earnings season, and next week we're going to see some of the big NASDAQ names. I think Microsoft, Google, Apple, Amazon are all going to report. We have Tesla today after the bell. And this could positively impact the market in the near term, because you are in a position where, number one, everybody is very bearish. Number two, you have a lot of bearish positioning last Friday. I think it was a record amount of short selling. And also there was alleged, I saw a couple of websites where they said that the ratio of put buying was 3-to-1 among retail investors. I don't know if retail investors have enough money to be buying anything, whether it's puts or calls or, cigarettes. I don't really know, but I don't really think so. So I don't know if they're too much of a factor. But we do know from the National Association of Active Investment Managers that they're back over to the bearish side of the boat. So positioning, I think, is more important than sentiment, because retail investors have been morose for the last several weeks, yet the market has come down. So it's pretty clear they're no longer a factor. But institutional positioning, hedge funds and the like, is something to pay attention to. And we do know that there was a large amount of short selling occurring on Friday. And once you had the news over the weekend that the UK was going to rescind all the tax cuts, and I guess other elements that they were trying to blame their gilt crisis on, and I mean British gilts, GILTS, which are British bonds, their equivalent of U.S. Treasuries. And And I think, you know, that's really the real issue here is that they've been behind the curve in addressing inflation, and that's what screwed up their bond market and created a currency crisis. Okay, meanwhile, the Fed is going nuts raising rates. So obviously the relative, the crosses, Forex crosses, the pound to the dollar, the yen to the dollar, the euro to the dollar, those are all declining as those currencies reap the consequences of the slowness of those respective central banks in terms of raising rates to address inflation. So that's really the crux of the UK problem. But you know, they're trying to make it sound like, oh, it's the taxes. So it seems absurd, but you know, all oversold rallies are going to be absurd because they look like they're occurring based on some ridiculous news, right? But the thing to consider is maybe the news is just an excuse, an alibi for the rally to call people off of the rally, right? To make them think, oh, this is not legitimate. But maybe the market's really discounting the future rather than the present. So there is that aspect to consider. And I think that becomes very tricky. So again, that's why I think this is an environment for nimble traders if you can catch it. And if you know, if you're OCD like me and you want to play in the sandbox because you just can't leave it, you know, so that's that situation. So I think you need to be cautious here. In terms of what you're dealing with, and be ready to be fooled because it will fool you here. And also accept the fact that the market may not necessarily be reacting to news. It may be discounting something that we don't know yet. And the primary one would be the fact that the market's going to figure out before the Fed when the Fed is going to turn the other way. And I'm pretty convinced that the Fed is going to have to. Chris, what's your take on that? You think they're going to turn too, right? At some point, they're going to have to.
They're going to have to, but the thing is, market's volatile and we're in a downtrend, and you know, we might have capitulation before that happens because there's another 75 basis point rate hike on the way. So it's pretty treacherous times. And again, I think that the economic reports are coming in pretty bad. I don't think everything just reverses to the upside on a dime, or rather, I would say it this way. The worse they come in, actually, the better that is for the markets, because then the odds shift that they're going to have to hike 50 instead of 75. So that, of course, that could create more of a dead cat bounce, or could create like a lot of sideways choppy environment. And meanwhile, we get a 75 basis point rate hike, and then maybe by December we get a total about face like we did in December of 2018, and that would probably be a major low for the markets.
Yeah, I think the one thing where I would say I think the market will figure it out before the Fed does. So I think that's what you got to be watching for. So now here we're coming in a little bit here. But anyway, something like a Netflix can simplify things. And somebody's asking whether you would, use a post in pre-market hours for a double top entry. Well, you can do that. And it was actually a short overnight because I actually shorted in the pre-open rather, and I used this somewhere in here, got short, and then I covered before the open because I figured that they're going to push this thing back to the upside, and sure enough, they have. And you had a MACD cross right at the open, so that was a long entry. The other thing is that it set a low right at the open at 265.11. And so if you were watching that, you should have seen that as a long entry spot, and then you're off to the races from there. Now you're chopping around. You got another MACD cross to the downside. I suppose you could test that if you want. On the short side, I think it was good for a trade so far, and now we'll see whether it's got more, additional legs here, or whether it flips the other way. And that's a possibility too, So it's just a wild environment where everything is just spinning all over the place. So, there's this situation with Netflix is an example of a swing trade, a day trade that you can get after a stock reports earnings. Like I said, as we're moving into the thick of earnings season, then the potential for these types of setups to present themselves after a company reports earnings. So like I said, we got Tesla after the bell. What else? Let's see. Who else do we have today? Let's take a look real quick. I think today we have Tesla, and who else, Chris? Do you know? Let's see.
Tesla's the big one. I'm not sure of the others, but I mean, Well,
today okay, here we go. Alcoa is one of them. IBM is going to be another one. Lam Research. and I'm assuming this is Wednesday, October 19th. Yeah, Lamb Research is another one. Las Vegas Sands, Steel Dynamics, Tesla, and that's today after the close. So you got some more potential situations that could arise. So now here they go, taking everything red again. Now probably what they'll do is they'll turn it back the other way, and they're just going to spin it back and forth. But like I said, I think you're just in a very volatile situation here, and things are going to be spinning all over the place, and it's going to throw you. It'll throw you, and so you may be better off not playing, or if you are playing, play small. Okay. So anyways, so there's Tesla. You can see, yeah, it's trying to bounce off these lows. You got a little undercut and rally going on through this low here. So I don't know if you see that. And I think I wouldn't be surprised if it rallies after earnings as well. So somebody's asking about Snap. Snap, yeah, that's acting like a short along the 50-day line. So, if you want to go after it on that basis, you can. But again, keep risk to a minimum by understanding where your cover points are and adhering to them. Because I think they could get this thing pushing, this is like a delta grind, the delta express here, where you've got all this negative delta in there that everybody's been, buying puts and whatnot. And that's what this is, like a steamroller. And so it'll run up and come in, and all it does, the volatility just swings you all over the place and screws you up. And some days you're just better off doing less than more. So this may be one of those days, or we may be in a situation here where that's the case. Now, if we're in the panic zone, there's two panics that can occur. You can have shorts panic, and then you get this sharp rally that would be much more than we've seen so far. In my view, you haven't seen much of a rally here yet. These have been relatively small. 3% is nothing. So that's a possibility that I would be watching for. That this could continue higher. But the other panic is where the longs panic and you get a big climactic low. Now, that assumes that there are any longs left in the market. And I tend to think that, a lot of this may be sold out. And while it doesn't have the ability to rally, then I think you just may be stuck in like this sort of netherworld where you're not going anywhere. So what am I thinking? Purgatory. Yeah, price purgatory. Anyways, let's just swing through my charts real quick and what I'm looking at in real time today. These were some of my daily notes short from yesterday, early in the day. And you can see a lot of these stocks reversed at moving average resistance, but today they're regaining it. So I just watched the stock setups. I wouldn't get hung up on, give me 1 second here. I won't get hung up on, trying to be pig-headed about it. Because let's face it, the short side has been great over the last, 10 months. So, relax. No need for a big rush. And if you're late to the party and you're trying to get short now, well, you might run into some problems, or you just might be spinning your head around. Now they're turning it negative again, so it's looking bearish. And we'll see how this goes. I mean, you could get a panic move to the downside. I'm just not sure there's that many longs, but we'll see. You could get an air pocket too. There's that possibility. But I think it's just a very tenuous environment again. So any other questions just real quick, because I'm going to run through this very quick. But you can see like home builders are rolling over today. So you have, because of the housing data. But for the most part, First Solar has been a short along the 50-day line, and that has worked. You can see that. Where are we? Other thing like Fortinet, it looked like a short at the 65-day, exponential yesterday, but notice how it's pushed back above it after finding support at the 50-day line. So, not in every case am I seeing things blowing up in terms of individual stocks, and I would refer to individual stock setups first and the indexes second, because they can make the indexes go all over the place. The fact is that over the past couple of days on Monday and Tuesday, when you had sharp rallies, there actually were a lot of stocks that were pushing into short sale entry positions, and they rolled over. A lot of them rolled over. But then, like Goldman Sachs yesterday, right at the 50-day line after earnings, and it came in good for a scalp. So there you go. You got a nice swing trade, and that's that. And after that, you're all over the place. Juniper Networks actually on Friday was a nice short at the 20-day line, but notice how it's pushed past. It's up today slightly, and it's pushing up against the 50-day line. And so these are names that I had on my short sale list from the last couple of days, actually. So what else we got? Let's see. You got take two pushing up into the 50-day line. Now your assumption would be that, oh, I'm going to short this here, but it could just push right through. If you look at it purely on a price action basis and just forget the moving averages. So I think whenever you look at a chart, you should just take the approach of where you look at it. Yeah, okay, they're the moving averages. That could be moving average resistance. It will tend to work, however, in conjunction with the market. Don't forget that. That's a key factor whenever you're shorting. But if you look at something simply on the price basis and look at the price chart and the volume, what's really happening here? Well, it's going sideways, and when it comes in, the volume dries up. So that's what it's doing right now. It doesn't mean it couldn't reverse and the volume picks up, but I think to assume that it's necessarily going to roll over in here may or may not be sound, and I think you have to play it as it lies, and you have to be nimble. So again, we get back to this whole thing that, you want to be stuck in front of the screen all day, and you're going to get arthritis from clicking your mouse all the time. I love to do that. Then be advised. Anyways, any other questions? United Airlines, they came out with earnings today. I actually shorted this in the pre-open, and then it came in hard real quick. I covered it because I could see that on the 620 chart. It was turning, and this was all in the pre-open, I believe, if I recall correctly. Yeah, so, they had it up here, and so I came in, I get up at 4, and I'm like, yeah, okay, let's short it. And I get a couple, dimes, I like 50 cents out of it, something like that. And then it comes in hard right at the open. So you can see this long lower tail. Probably what I should do is use a thicker tail, but you can see the long lower tail underneath 38.50. That was a cover point, and then it shot out of there. Now it's rolling over again, so maybe it becomes a short in here on that basis. But the reality is the MACD cross occurred around $40, so that's really where you want it to be in. You might be a hair late, and in this market, you're either Johnny on the spot, or you could get your head kicked around a little bit as things push against you. So, it's a fascinating environment, but some days I feel like it's really difficult to figure out what to do. So, but I'm looking for, I'm actually looking for some kind of a rally, because everybody seems to expect that it's October, everything's terrible, everybody's morose, all of the sentiment, all the positioning has been bearish, and we'll just see how that goes. And I also think that the potential is there that there aren't many sellers left. So you need another rally to create some new long holders in this market. So anyways, getting back to United Airlines, that was one that worked. But I mean, some of the bigger names, you look at Agco, yeah, okay, they're kind of slopping around, but there's really nothing here, not today at least. And then the fertilizers are chopping all around. You can see most of these stocks are just chopping around in ranges. You might get an ugly day like you had with Mosaic, that was last Friday, and that, for all intents and purposes, looks like it's just going to blow up, right? No ifs, ands, or buts. But it doesn't. So, and I think what happens is you do get a burst of selling. And the selling may not even be natural sellers. It may be short sellers or put buying. And then what happens is that runs its course, and then boom, you get an air pocket back the other way. So that's something else you have to watch out for. I think it's a very dangerous environment as well. So tread lightly. Just some key areas. I'm watching industrial metals, and I think if we did get a turn on a Fed pivot, then the commodity space would probably be the place to be. Cleveland Cliffs, a lot of these are just hanging up here, coming up off their lows, and they're chopping around. But it might be a good idea to look at some names in this area. Now my approach, I don't screen. People are always asking, oh, what screens do you use for this, that, and the other thing? I don't really screen. What I do is I just work off of, I run a daily volume screen, so it gives me some idea of what's moving, both upside and downside. And then what I do is try to figure out what thematic areas of the market are important. And so then what I'll do is go in and I create all these groups. And you've noticed that when I run through this, I've got all these groups, my GISME groups: solar, space, telecoms, travel, semiconductors, retail, railroads, miners, IPOs from the last 3 years, home builders, financials, etc. And what I do is go through these very quickly in real time, and I get a sense of what's happening overall with the stocks. And that gives me a better view of what's going on with the market. The other thing is that sometimes I'll pick up counter trends before they are apparent in the indexes, because they will always start with the stocks. The stocks make up the indexes, so better to watch the stocks and operate on that basis than trying to figure out whether the index is up X% on so many days after a low and blah, blah, blah. So, to me, that's really the way to handle this market now, and that's how I operate. So I don't screen. So that is all to say that I don't screen. Anyway, so what's going on now? Now they got the Nasdaq's down, 0.5%. The Dow's down 0.14. The S&P down 0.5%. Okay, so are we blowing up yet? No. What are we doing? Not really clear. What are the stocks doing? We're looking at some charts in real time. What's really happening? Not much. I think the home builders may not be happy today on that data, and you can see they all broke. So that was possibly an area you could get short. If we look at big stock semiconductors real quickly, they're all here, trundling along the lows. Maybe they turn off the lows. They're so oversold at this point. And I notice in a lot of these names, I've been getting a lot of oversold bingo bars. Those are those vertical gray bars, and they're getting thicker and they're starting to pile up. And in the past, when I start to see at least 3 or more of these showing up, it may be telling you you're getting ready to turn. That's a possibility. So again, if you just got here, if you just signed up and you think, oh, I'm going to come in because, these guys wrote a book on short selling, blah, 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 and they know what to do. And yeah, well, we've been working a few names and you don't really need a lot. Celsius Holdings has been one, and that has worked. We were getting shorted up here at about 110 on the double top. And then when it busted the 20-day in here and pushed back up to the breakout point, we're getting shorted again. And then you're getting short again at the 50-day line. Now you're just chopping sideways in a bear flag. So we'll see where this goes. But it is essentially a punch bowl of death in progress. You can see the big chart there. I'm getting the blue circle of confusion. Here we go. First Solar, same situation here. That's busted, and we've been on top of that. So, we've picked up some short sale entries on things, and they've been working, but it's very difficult. You'll get sharp breaks, and a lot of times you get all giddy and excited over the sharp breaks, and you want to add to your position, or you really want to get aggressive. That's usually a mistake. So I use the piggy principle. When I got a big move coming my way and moving my way, if I'm short or even long, I'm inclined to take it. When I have it. So, even an example like, let me go to my leaders list here. Whoops. So you look at something like Axelis, look at this move here. I mean, that's a huge volume move to the upside. It's a one-day wonder move, and then the thing blows up. Boom, out go the lights, or rather, boom, boom, out go the lights, and there it is. It becomes a short sale entry. So, when you have a big move like that, you're best off taking it. And even if I had shorted this, say on the double top reversal the second day, probably at the 20-day line, I would have covered. Then I'll come back the next day and work it off the 20-day line there. So, but that's what it requires. And yeah, for some people, it's too much thinking, too much activity, too many clicks of the mouse. Think about it. Anyways, do I dare say UNR Boyle? What is Boyle? I don't know if that's an oil ETF. Nat gas, long nat gas. Well, it is trying to pull off the UNR. I mean, not really. It's kind of marginal. I mean, if you think that natural gas is going to turn, then go for it. At least you know where your stop is, right? So your low here is probably around, let's see, let me go. I'm going to go to my buddies over here at HCSI, Boyle. You're looking at the UNR here. So let's see, where are you at right now? Right now you're trading at, well, your low here is 38.71, you're at 39.16. So you're trading above that low. So that could be your stop, and you could give it a whirl. That's a reasonable trade. But again, make sure you're fast and Johnny on the spot, because if you don't catch it right, I would say right now it's pretty close to it's like 1% from the entry point. So that's pretty reasonable. But, just be fast. But if you find a setup like that, I don't see why you can't test it. Anyways, that's all I've got. You got anything else, Chris?
I think we're good over here. Let's just keep watching this topsy-turvy volatile situation unfold. But I think we still may have some short covering because what was it? Put the call was at 3-1, which is I think one of the highest
Yeah.
ratios
To call
on that spike.
Yeah.
Yeah, and I mean I think a lot of the trades may have been forced to cover. I think that's what we saw this week so far with the rush of buying pressure. But I'm sure there's probably still some funds out there that are sitting in their put positions. So these short covering rallies can take a while to play out. And with earnings season upon us, and with maybe Tesla has another gap up like they did last time, and that could just push the our averages higher in lackluster manner. All the way out to closer to the next Fed meeting, where I think there's going to be a lot of concern because so far I think the Fed to remain consistent, they have to continue to be really hawkish. Unless we start to get some really weakening evidence of the economy. So I'll have to keep an eye on that as well, because when you get a really bad report these days, the markets tend to rally.
Yeah, so we'll see how this all plays out. But again, if you're playing, my approach is to create a lot of different groups. You see the ones that I create, and I do it by hand. I don't screen form or anything, and just monitor it in real time if you're going to play. Otherwise, I think just stay in cash. Anyways, that's it for now. Thanks for showing up, you guys. We'll catch you next week.
So long, everyone.